Given its current performance in the stock market, what do you think will happen to Tesla's stock in the coming weeks? Today's economy is a great cause for concern, and it also affects the stock's volatility in the market. Social Capital CEO Chamath Palihapitiya believes that Tesla stock will crash next week, so you surely would not want to miss this info. Billionaire Chamath Palihapitiya is painting a bleak macroeconomic picture despite signs that inflation is starting to cool down. In a recent episode of the All In podcast, Palihapitiya doubles down on his call that the Federal Reserve will keep hiking interest rates. Higher than all of you think and higher than all of you want. Chamath Palihapitiya is a Silicon Valley venture capital investor who has made himself into a tech firebrand. He is a proponent of SPACs, a kind of investment vehicle that allows private companies to go public with less scrutiny from the SEC. Palihapitiya is a sponsor and investor in half a dozen SPACs. Companies they have merged with include Virgin Galactic and Clover Health. He is also the founder of Social Capital, a venture capital firm that he started in 2011, although the firm faced a wave of defections in 2018. In late October, so-called SPAC king Chamath Palihapitiya said the zero interest rates the Federal Reserve allowed to persist for years created the perverted market conditions he benefited from at the height of the COVID pandemic. During an Axios event, Palihapitiya explained what he felt contributed to the rapid rise and collapse of the SPAC market, the shorthand for special purpose acquisition companies, which created a way for young firms to go public without some of the usual IPO hurdles. SPACs, which grew in popularity in the first 2 years of the pandemic, have seen a reset amid economic and regulatory headwinds. Still, there are more than 450 deals on the market for a merger target ahead of 2023 deadlines, according to SPAC research. We are learning what went wrong, which is that we had a decade plus of zero interest rates. Palihapitiya said of the market, "That is what fundamentally was wrong. It perverted the market. It distorted reality. It allowed manias and asset bubbles to build in every single part of the economy. Low interest rates mean lower returns on savings accounts, which can encourage more spending in the economy, which can be a boon for high-growth assets." Nearly a year after accurately forecasting this year's meltdown in global markets, billionaire investor Chamath Palihapitiya says he's positioned to capitalize on a major market rally. In another All In podcast episode, Palihapitiya says he's bullish on the S&P 500, as he believes the stock market index has carved a short-term bottom. "I think this is the point where you have to start to get pretty constructive about where things are going. Because if this stuff could not bring the market down, it's hard to see something other than an exogenous event, probably some Russia-Ukraine event, really having a negative impact. It seems pretty bullish for me," says the venture capital investor. Although Palihapitiya is bullish on the stock market, he predicts the rally will likely be unsustainable. He says that he agrees with the sentiments of fellow venture capitalist David Sachs, who believes that the U.S. will likely see a huge recession next year due to the impact of the Fed's rapid interest rate hikes on the economy. "I think the stock market is going up. Then it will go back down because what David said is right, but for the short term, this thing is going up. We've generally been positioned for it to go up, and at some point we will reverse and position for it to go back down, but it's going up." However, this was in late October and things have taken a turn since then. Now, Chamath Palihapitiya is warning investors that the Federal Reserve is determined to crush demand in an effort to tame inflation. In a new episode of the All In podcast, Palihapitiya says investors should buckle up now that the Fed has signaled that markets will likely have to endure more interest rate hikes than consensus expectation. According to him, if you take a very balanced view of what happened in the recent weeks, you have to start with the Federal Reserve. What they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. Without debating whether that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it, says Palihapitiya. He added that it basically means that the dollar that's right in front of you is now meaningfully more important than the dollar that's far away from you. It can be noted that the U.S. Federal Reserve recently raised interest rates by 0.75% for the fourth consecutive time to bring the benchmark federal funds rate at a range of 3.75% to 4%. Investors generally expect interest rates to top out at around 4.75% by next year. However, Palihapitiya says that investors should now be prepared for a scenario where the Fed keeps raising interest rates until 2025. Powell said he'd rather overcorrect and break things because he has a toolbox to fix the broken bones, but he doesn't have a toolbox to fix it if they undercorrect and they have a rampant inflation. Not more explicit you can get, shared Palihapitiya. He further explained that the Fed is going to take rates higher until demand is destroyed and enough demand is destroyed such that inflation is tamed. But that has huge implications to all of us because we all have to do our job trying to build a company, trying to raise money, trying to invest money. He added. Palihapitiya said that it's getting much harder than he first thought. He initially thought that the US could get through the worst of this by mid-2023. However, it does not appear so. But now you have to plan for the worst, which means, okay, now I'm thinking, man, rates could be higher for much longer, which means we could be in this market until early 2025, he said. Of course, this could greatly affect Tesla too. Even today, Tesla stock is exhibiting extreme volatility in the stock market. The stock is still trading below $200 since it dropped to around $197 on November 7th, and it appears that things are going to get even worse. According to Chamath Palihapitiya, he sees inflation rearing its ugly head in the next 6 months, which he says would embolden the Fed to keep raising interest rates that would subsequently trigger another sell-off event in the financial markets. We have all of these positive news in the offing, but the problem is, again, there is still a lot of risk to the downside. We haven't seen David's second dip in the recession, so that double dip is going to be expensive, says the venture capitalist. Palihapitiya further predicts that the Federal Reserve will push interest rates to 5.5% until the first half of 2024. According to Palihapitiya, a high interest rate environment for an extended period of time will annihilate hundreds of billions of dollars worth of venture capital. According to him, we are just getting started to see the drawdowns as well as starting to see the impacts on people's portfolios. That will drive behavior change. This SBF, Sam Bankman-Fried, thing is the tip of the iceberg in terms of the money at risk, says Palihapitiya. Sam Bankman-Fried is the founder and former CEO of FTX, a crypto derivatives exchange that filed for bankruptcy last week. Tesla shares continued a recent slide, hitting a 2-year low on November 21st when the stock was down 6.8% to about $168 per share. That's the lowest level since November 2020. The reasons for the decline are some of the same that have contributed to the more than 40% drop in the stock over the last 3 months. In mid-November, Morgan Stanley analyst Adam Jonas, a longtime Tesla bull, came out with a new note to clients in which he noted that Tesla's stock is getting closer to his $150 per share bear case, and that makes it more attractive on an EBI-TDA multiple basis. According to the said note, Tesla shares would trade at approximately 12.5x EV/EBI-TDA and 23x PE on our FY25 forecast, SBC burdened, which we see as excellent value for a self-funded 20 to 30% top-line grower in top position to benefit from re-architecting the U.S. onshore, nearshore, friendshore renewable supply chain at scale. The analyst believes that it is creating a window of opportunity opening for prospective Tesla investors. Despite challenges, including decelerating demand and price cuts in China, Tesla is the only electric vehicle maker covered by Morgan Stanley that generates a profit on the sale of its cars, Jonas wrote in a note. The analyst, who also highlighted Tesla's potential to benefit from consumer tax credits in the U.S., reiterated his $330 price target. Overall, macroeconomic issues put a blight on Tesla's anticipated success, as Silicon Valley venture capitalist investor Chamath Palihapitiya warns against a bleak scenario in the stock market. Still, there are those who remain optimistic about the leading EV company's future. Subscribe to this channel and have a great time watching.